All right, I'm going to jump right into it, guys. I've got a couple things I'm really excited about to share with you today. Uh, that is I think pretty tactical stuff. And as always, I know half of you for the most part are new, half of you are not new. I recognize a lot of the names right there that popped up in your chat. You might be clients of ours or have listened for a little bit with us at Horizon Trust Company. Uh, today I've intentionally chose two topics that I think are good timing for what's going on, especially today. I don't know if anyone's noticed the stock market, what's going on in the market today, but also just some things that are very applicable to this industry and this space and protecting your money. Look, it's always about when we meet and when we talk, the message is always about um, taking control or back control of your money. And and this message again today is going to be very tactical about how you can control your money. That being said, I want to share an example to kind of get going. The importance of understanding where your money is at and putting it in vehicles so it can really grow and you can truly create great wealth. And so the example I want to give you is actually one that my son just gave, Carson. When I say just, Carson and I just recorded a podcast this morning. And for those of you who have not seen our podcast on YouTube, I definitely think it's worth watching. They're usually quick, 15 to 25 minutes. Maybe the first ones are probably a little rugged because we were just starting out, but as we get going, the last, 5 or 10, I feel like I've been very much on point. But the example he gave that I wanted to start this presentation out with you on is the importance of compounding interest. Now, we've talked about this before, but I want to put it in some real numbers with you. So we all know what compounding, the importance of compounding is. But let me give you this example. If I were to give you the option of giving you $1 million today, or one penny today that's going to double for 30 days in a row, which one would you like? Now, I've already kind of given away the answer. I assume, and maybe you can throw it in the chat, which one do you take? Which one would you take? A penny a day or not a penny a day, a penny now that doubles, or $1 million? Julia first to say, I think she's in Brazil. Um, yes, it's the penny. Now, what is a penny compounded daily, right? 1 to 2 cents, 2 to 4, 4 to 8, and so on and so forth. What is that after 30 days? Any idea? Don't no one no one use Chat GPT. Real quick. Any numbers here? A lot. Yes. Is it over 2 million? Yeah. It's over $5 million. It's over $5 million, $5.3 million over a 30-day period. Now, let's just say that you decided that during that period on day 15 and maybe day 25, that you needed to pull out $100, just $100. So on day 15, you pull out 100. Maybe on day 25, you pulled out 100. How much do you think the 5.3 goes to? It goes from 5.3 all the way down to $2.8 million. 2.8. So it's almost a $2 million difference by taking out money. Now, the other thing I think that's important to share is what if I were to share with you, there you go, the exact number. Thank you in the chat. What if I were to share with you that I had this penny, but every day I had to pay 2% on that money? 2%. Now, why do I say 2%? Because the average account in today's world, if you have a retirement account somewhere, typically outside, obviously, of self-directing, what I'm here to talk to you about today, but in the stock market, you're paying on average 1 to 3%, 1 to 3. Okay. So, and regardless of what you think you are, if you're in the stock market, these mutual funds, et cetera, these different kind of all these different marketable securities, there's fees associated to it. So let's just put fees associated to this penny, and every day that it doubles. If you take out 2% at the end of 30 days, you would not have 5.3 million, but you'd have 2 million. 2 million. The fees hit you over $3 million, basically. That's another example. Now, the last example I'll give you, I think, which is the most powerful example, and one of the reasons that most of you today are listening that have a self-directed, why you want to self-direct, or use a vehicle that helps you protect from this biggest thing. But what is the biggest expense? What is our biggest expense? And then I'll jump into this PowerPoint that I've prepared. Yeah, I'm waiting. Yeah, I am. There you go. Thank you. Julie, you're on it. The first one to respond here. Our biggest expense is taxes. Let's just say that the taxes on this penny that doubles every day is 15%. This compounding example I give you, just 15%, not more, not less. What do you think you'd have in that account after 30 days? The answer is a little over $500,000. It's over a $4.5 million penalty, if you want to call it that, by not using. I'd say it's a penalty on us if we're not using these vehicles to avoid paying taxes and to compound your money. So the power of compounding and avoiding paying the taxes is a million or millions of dollars of change in your wealth and your preparedness for retirement. And I can't illustrate it or talk about it enough because I feel like numbers, it's math. And so we could talk about like all the sexiness of self-directing and avoiding fees in the stock market. And end of the day, the biggest inhibitor that we all will face is taxes. And so these vehicles, the one in particular that I talk about today and that a lot of you guys are involved in, is self-directed, investing your retirement funds, putting money into it, letting it compound. Now, let's just say it compounds every year, right? Not every day. We would love that. But every year over 30 years or 15 or 20 years and not paying tax on those gains, we're talking about millions of dollars. And so that's why this vehicle of self-directing is so critical. It's also why this subject of using a vehicle that's been around for over 40 years is so important. So that being said, I would like to jump into a couple things I prepared for you. So, all right. So I want to jump into this. A couple things that the first couple slides are just for those of you who don't know me, I just want to share. I've added something to the last slide. The last bullet point there, soon to be grandfather. Yes, proud father of 5, but also my oldest is and his wife are expecting. Super excited about that. When I talk about stats as far as success go, those are probably the most proud items are there at the bottom. I have obviously built a very strong business and done pretty well. Definitely have had a lot of hurdles along the way. And I feel like the hurdles is where I've learned the most. And it's also why I'm able to share with you what works and what doesn't work. So hopefully you can take the couple things I've shared, I'm going to share with you today and apply them to your wealth building strategies. So again, for those of you that are new, so bear with me. Those of you who've been with me, I got to share the first like 3 or 4 slides, and I want to jump into this. But for those of you that are new and that have heard about us on an ad or on some kind of social media thing or a new potential client, we truly care. We're a boutique firm, care about your success, truly. And that being said, the self-directed IRA is basically a vehicle that was approved over 40 years ago in the 70s that allows an individual to use their old 401k or 403b or 457 or a current traditional IRA or Roth or Simple. If you have any one of these type of retirement accounts, you qualify to be self-directing, which means you can take back control of your money and invest it in things that you know, like, and understand, which is going to lead me to the part of the presentation here that's going to talk about what you might know, like, and understand. This is not for everybody. I'm not a financial advisor. I'm not a CPA. We are a company, a trust company, a licensed trust company. It's been around for 15 years that helps individuals understand what a self-directed IRA is, because most people just don't know that they can do it. And most people, if you're listening to this for the first time, don't know you can do it because typically your advisor doesn't want you to do this, because if you self-direct, they do not get their fees of 1, 2, 3, 4% per year. Now, yes, there is still a fee. Our fees are less than 1% per year, anywhere from 0.25% all the way up to 1% for us to be the custody or the custodian of those funds. But how I look at that is we now are giving you access to your retirement funds to invest in what you like and what you know. There's a few rules along the way that we'll teach you and make sure that you're protected on. But this has been a powerful thing for me in my life. And this right now, in the example that I gave you in the beginning, of turning your 1 penny to 2 to 4 to 8 to $5 million can absolutely be done over a 10, 20, 30-year period inside a self-directed IRA. And so I share this with you as well because many people, when they hear about this, maybe even you listening to this, that have a self-directed IRA are not contributing or are only contributing every once in a while or are not investing their funds in a way where they're earning 5, 10, 20, 15% on their money. When you make that money and you compound it, that power is huge. We're talking about millions of dollars over decades just by using this vehicle, self-directing, to invest in something that gives you solid, hopefully double-digit returns. And I do it. I've seen so many others do it. I see my son doing it now. My 18-year-old's now learning how to do this as well. And for those of you that are listening as well, and I'm going to get to something, I actually have a gift that I'm going to give to everybody that's unique. We've never done before here towards the end. So stick with us here to the end. But I will say that even those that already have an account that might have been thinking about getting their spouse and or kids set up, you too should be doing that. And I'm going to show you a couple examples of what I've been doing as well. So a couple of things here. I think I already mentioned this as far as self-directing, understanding where your money currently is, I think is the first step. You might not know that you're paying this much in fees, but you most likely are. And that's typical, by the way. I was for the longest time. My parents were their whole lives. It's very, very normal. There's over 100 million now accounts, retirement accounts in the United States that now have over $8 trillion. That's a powerful number. Most likely you are part of this number if you're listening or you know somebody that's in here. And I like to share that basically 1/3 of the population has some kind of retirement account. And most people are not paying attention to it. And I would say one of the main reasons they're not paying attention to it, and this could be you as well, is that you can't touch it and use it today. I mean, you can't go on that vacation or go buy that new car with your retirement funds. That is definitely short-sighted as far as viewing and as far as planning for your future, because I can tell you, I feel like even though I can't touch it, I feel like I can. I can touch it, meaning I could lend to somebody, a friend. I can invest in precious metals, Bitcoin if you want to, or businesses. Most importantly for me, I love investing in real estate, and those gains go back into my retirement account. So there's so many different things you could be investing in. So that was, that's the kind of the summary for those that are new, that want to know about self-directing and how it works. Absolutely schedule an appointment with me and my team. Alex will put here in the chat or in the question answers as well, a link for you to schedule an appointment with myself and my team to see if your account qualifies. I think that's an important thing too. A lot of people hear my message and they don't think that their account qualifies, and most likely you're wrong. Or number two, a lot of people think my retirement account's too small. I have this old 401k. In fact, a lot of you probably listening have this old 401k that might only have $10,000 or $15,000 in it. Those accounts still apply and can still be, you still can maximize them. Take the penny example. If you can get that $10,000 and get and just you don't have to even double it every year. Get it from 10 to 12,000, 13,000, and then you compound on the 13,000. You'll see after a decade, after two, all of a sudden, literally can have millions of dollars in your account. So it's a big deal. So what I want to talk about here is a subject that people have brought up to me, not very often actually, and they're not very aware of this. And so this is one of the two subjects I want to share with you is non-recourse loans and how to do this. And so what this means, can you borrow money? And here's an example. Let's say, I think I've got it right here. Well, actually I will in a second. Can you borrow money? When I say you, can your IRA borrow money to purchase real estate? So you can borrow money, but it has to be a non-recourse loan. Basically meaning that if I'm going to borrow money on a piece of real estate, and my IRA is going to borrow money to buy a piece of real estate, I cannot personally guarantee the loan. I cannot be liable for it, nor can the IRA. I wish all loans were this way, by the way, but they're not. Non-recourse lending is meant and set up for collateral-based lending, meaning the lender, the bank, cares about the asset only, not the borrower, and that they've lent out only enough to feel like their liability is very low. So if there ever was a problem, the IRA or whatever there was some kind of issue with the asset, the lender would take back the property, but they could not go after the IRA or the IRA owner. That's what a non-recourse loan is. I wish there was more non-recourse lending out there, and there is, by the way, for also non-IRA investing. But non-recourse lending is one of the best. Even though it's a little higher return, I mean, a higher rate, it's one of the best things to do. So let's talk about it a little bit more. One of the first steps you do if you want a non-recourse loan is you have to open up a self-directed IRA, fund the self-directed IRA with either a contribution or a rollover, funds that are transferring from one of your other retirement accounts over to us at Horizon Trust Company, find the investment property, then find a non-recourse lender that will lend to you. And then the loan that the bank lends to this asset is in the name of your self-directed IRA and not to you personally. Then any rental income that comes in from the property covers the loan payments, and anything above that goes into your retirement account. That's kind of the process. Now, I want to give an example here of a return that you can make. And this comes up quite often because maybe you could be one of these people where you're like, okay, I only have, in this example I'll give, I only have $80,000. And in my area where I live or where I want to invest, I want to buy properties, but the properties are around $200,000 to purchase. You can see the problem. So there's a couple ways you can do that, right? If you want to take down a property and only have $80,000, you can partner with somebody, right? Other people that have funds and or IRA funds to buy it for $200,000. You could also you could get a hard money loan as long as it's a non-recourse hard money loan, or you could get a non-recourse bank loan, which I recommend because the rates are better typically from a bank than they are from hard money. For those of you that are used to or have borrowed money from other individuals, hard money or private lenders, and they're in the double digits, 12, 13 or more percent, it can get quite expensive. Here's a simple example. Purchase price of $200,000 with an $80,000 down payment. The non-recourse lender would be lending around 60%, which is about accurate, excuse me. For a loan for $120,000, the monthly rent would be $2,000 and the loan payment would be $750,000. The net income after expenses is about $900 a month. The return on that is over a 13% rate of return on the $80,000. So does it make sense to lend or to leverage and get a non-recourse loan? In this example, yes. In many examples, yes. So don't be afraid or don't be worried if you think, oh, I've got an account that's too small. A lot of times you can get non-recourse financing, which allows you to go to different markets rather than maybe there's some markets where like Alabama, or there's little pockets where there's properties that you can buy for 40, 50,000 or 80, 100,000. And that's all you think you can do. You can go to other markets in Florida and a couple of other states and start purchasing properties for 100, 200,000 or more, depending upon the size of your self-directed IRA or depending upon the partnership, which I'll talk about here in a second. But non-recourse is a big deal. It allows people to leverage and buy more real estate and give you better returns. So here's just a quick list of some of the pros and cons of non-recourse. Allows you to buy more. I've already said that. Keeps your personal finances separate, so you're not having to put up any personal liability. It helps you build wealth faster inside your IRA. Cons are the rates are a little higher than traditional financing. Obviously, since a typical bank, right now you can probably get around 6%. And from a traditional loan, these non-recourse loans, because there could be potentially more liability, what we see is they're typically a few points more. And when I say a few more, you'll probably be in the range of anywhere from 7.5% to 10% when borrowing from a non-recourse lender. You obviously also need, it requires a rental income to qualify still, so making sure the asset's going to be able to pay the debt on the loan. And the loan to value, they typically lend less because obviously there's a little more risk for them. So they'll lend, typically I see around 60%, but I've seen them go all the way up to 75%. So I'd say that's the range, anywhere from 50 to 75%. So those are some of the pros and cons. So let me kind of move into that. And again, I'll pause for 1 second on this too. For those of you this is new to, non-recourse financing is kind of a subject that's a next level subject. I would say it's not elementary. It's not the brand new discussions, but I know I've got also a lot of listeners that have been with us for a long time. and I want to share some new content that you might not understand completely. So non-recourse is a big deal. It works. It applies to any of you self-directing that want to leverage and go out and buy more real estate. That being said, for those of you that are new that don't have their self-directed IRAs set up yet, but have these other retirement accounts, set an appointment, schedule it. We'll answer any questions you have to see if it qualifies to get you set up with us at Horizon Trust Company so you can start taking advantage of that. Now, the other subject I want to talk about is building family wealth and how the Checkbook LLC creates that with family. And I think I'm kind of excited about sharing this example because we've talked about it on prior webinars, but I'm going to dive deep into actually how this works or could work for you. So here's an example. You can plug in your own names, ages, etc. Let's just say in this example, Mike and Sarah each have $25,000 in their traditional IRA. And then let's say they've got 3 kids and they all have, or going to be created, a Roth self-directed IRA, okay, $6,000 each. Let's talk about what that looks like. So I'm going to move this so I can see this a little bit better. Johnson family invested in the multifamily flip. So let's say here's the family. So they've got, there's an opportunity for them to pool their $68,000 into an LLC. So let's talk about that for a second. So a Checkbook LLC is an LLC that we at Horizon Trust Company can help set up for you and or your family and or partners. We actually, this exact example of this Checkbook LLC, I have some people at my office at Horizon Trust Company who they came together and created a Checkbook LLC that's owned by their, I think there's like 7 or 8 of them, a portion of their retirement accounts all own this LLC. So what I'm sharing with you today can be applied to from a family perspective, but also from a business partnership and or friend perspective. This example is for family, which I love because now you're teaching your kids and getting them involved in the real estate world if that is something you want to invest in. Could this example, the Johnson family could be investing their money in something else. Doesn't have to be real estate. Could be in a business, could be something else. And so in this example, they have $68,000 from those traditional accounts that I shared with you, the 25-25 plus the 3 Roth IRAs, right? And then they have another partner that's going to lend $182,000. Now that could be a non-recourse loan. That could be an equity partner. That could be a hard money lender, whatever that is. But in this example, it's another partner that puts up $182,000 to buy this home for $250,000. So the LLC gets 25% of this deal. And after 12 months, they sell it for $325,000. The partner gets $75,000. The LLC gets 25%. Okay, you guys all with me? Here we are. Home sells, there's $75,000 profit. 25 goes to the Johnson Family LLC, which remember is owned by the Johnson family's self-directed accounts. So pro rata, it would go to each person's IRA inside the LLC. In this example, you can see Mike and Sarah each get their $6,800, and then each child would get $1,600 back to their Roth. Okay, so each of them get tax-free profits in the Roths. The kids, actually, that's monies it's never be taxed. That $1,600 goes into the Roth, and when they take it out at the appropriate age, long time from now, because they're young, they can take it all out, whatever is in that account, tax-free as well. It's super powerful. Now for Mike and Sarah, that $6,800 goes back into their retirement accounts, traditional accounts. So that $25,000 turns into $31,000 and change, almost $32,000. Now they don't pay any taxes on that, which is why I started this example at the beginning of this webinar. Is the power of compounding interest. This is something that you can be doing as well. So if you think that your IRA is too small, you can partner with others. By the way, when I say partnering with others, you can create an LLC with a business partner or someone else, and your IRA can be a partner, and they can do funds that are non-IRA as well. That can be commingled. Their profits would be paid to them personally. Your profits would go back to your retirement account. So the example here, as well as far as long-term growth, gets me excited, especially for those that are listening that have kids that are a little bit in the business, and that you can help them get a Roth set up. Turns their $1,600 at the age of 14. You can start doing the math. But if you do this compounding right over what's our period here? 25 to over 50 years. It's ridiculous, right? I mean, they put in $276,000 and they're over $10 million. Is this real? Absolutely. Yeah, if they take out some money here or there, don't make those kind of returns, sure, maybe it's going to be half that. But how powerful is that for your kids to start investing now? So that being said, look, there's a couple things I want to share as we go to question and answers, which is one of my favorite parts of the presentation. You can always follow me on Instagram or email me directly, Greg Herlean at Horizon Trust Company, and schedule appointment. I will tell you that for us in general, we love sharing with people how to implement these concepts in their families and in their personal and business lives. And so let me just actually, I'm going to do a stop share here. You can see me a little better. Okay. So a lot of you already follow me, and I get messages, DMs often on different real estate deals or things that are coming up. And I encourage that. I love that. Same with the emails. You can email me in the chat box. It's Greg Herlean at horizontrust.com, and you can schedule an appointment with me, etc. But there's a couple things that I want to share kind of in closing before I go to questions and answers, which is kind of my favorite part. As I shared with you the basic principle self-directed. Then I talked about non-recoursing and how important non-recoursing can be to leverage your retirement account to create wealth, real wealth, right? Rather than making 8 or 9% in your account, you can make maybe 13, 14, 15% by leveraging your retirement account. And lastly, talking about the Checkbook LLC, how you and your family can create an LLC and then go out and buy assets together or lend together. It's been a game changer. I've seen it in my own life. I've seen it in a lot of my staff, them also doing it in their retirement accounts. It is a game changer in creating wealth and leveraging so you can get into bigger assets. You might only have $6,000. If you're listening to this and don't have a retirement account, it's okay if you establish an account, put in $7,000 and start from scratch. The important part of starting now, as I started talking about compounding in the beginning of this, start investing now, compounding now, avoiding taxes to really get those big gains. And so we had a couple of things I think Alex and Claudia want to share. In fact, I'll bring Claudia on as well. And Alex, I think you got something as well. So Claudia, you're going to be sharing this with us. Where are you? There you are. Claudia, for those of you, I think a lot of you know Claudia. Probably prefer talking to Claudia. She onboards every new client that comes on. Works with Claudia and or her team. She is incredible and can help answer any questions as far as self-directing goes as well. But Claudia usually comes on and helps me with the answers. Probably because half the answers she also knows better than me because she sees them even more often than I do. But anyways, I want to bring Claudia on, and then also I think there's one or two things that we wanted to do this month that we've never done before. And you brought it up beforehand, and I think it'd be a great share for the whole group. So go ahead, Claudia.
Yeah, absolutely. Let's go into questions and then we can go ahead and go into we have some promotions that we're running for the month of March. Our marketing team called it March Madness. I don't like that name because I don't follow it, so I don't really know like the concept. I know it's basketball. I know that much, but that's all I know. But we have some promotions that we're running and we're really excited about it. We want to get some accounts going and definitely pay you guys for referrals that you guys send over. Our number one people that we go ahead and onboard are people that are referred by people that went through the process and they actually can attest that it does work. So our referrals are really important to us. So we'll go over that after we do some questions and answers. How about that?
Yeah, I do want to add something. I know you've got something you want to share, but as we have everyone on here, I want to share something I'd like to do this month that I don't feel like I've done maybe ever. And so the, I know there's a March Madness exciting kind of thing, incentive thing that we want to share with everyone here. But that being said, um, I want to share that if for this month, I think it'd be fun to for anyone that either gets their a kid that opens up a Roth or some kind of new account with us. If you're already an account holder, if you open up a new account with us for you or your kid or business partner, or refer us a client that opens up an account with us, uh, I'd like I'd like to do a call in April. We'll set a call that I'm going to take off my Horizon Trust Company hat and just do a call with those individuals. And that group could be just you and I, who knows, or there could be 10 or 15 of us. And the call can go as long as we want, can go hours long. But I want to share with you in particular what I am doing with my funds with my self-directed IRA. And I've shared some examples in some podcasts or some webinars before, but it's always changing. There's new opportunities, there's new things.
Mhm.
I see what my son's doing as well. But for those of you that refer us over a client and or open up a new account for them or their a kid, a Roth, et cetera, or Checkbook LLC, I'm going to do a call for you individuals and take off my Horizon hat and do something in April that would be unique and fun, but very specific on what I'm doing. So with my self-directed IRA. So I'm excited about that. So before we go on questions and answers, I'm sorry, Claudia, it's probably not what you wanted me to share. But just thinking about it, maybe it's because it's March Madness. I get excited when there's any kind of sporting event going on. You know, there's a little depression after football, so March Madness gets me excited again. So that being said, if you know somebody, you want to refer somebody, you've got our information, you've got my email, you got the link, whatever you like. We'd love to help. We'd love to help them. We want to kind of broaden one of our big goals. You're going to see more different, different incentives and things from us is we truly feel like more people need to know Horizon Trust Company and what we do. And so the best compliment ever is a referral. And so we look forward to working with you. So that's my hard pitch, guys. You guys know that I really love doing any kind of pitch, but that's it. And so I'm really excited about it. So now let's jump into question and answers. Claudia, let's go. If anyone's got questions, start chatting away.
That is great. So let's go ahead and we have somebody that says that sounds amazing. I'll get on it. So that's great. Yeah, we always have people that are asking, well, how do I get a hold of Greg? How do I get some time with Greg? Greg is traveling all over the nation speaking and sending our message. So this I didn't know he was going to offer this, so it'll be interesting. We're going to have to kind of, work with compliance, make sure that we don't go too off track, but it'll be a really, really cool, intimate setting where we only offer it to the people that actually get onboarded for March. And I would like to extend it. We'll see for March, but maybe like April and then do maybe 20, 25 people in a May session. That would be kind of cool. But yeah, I love that.
It'll
That
be
that
fun.
would be
There'll be no
awesome.
time limit. We'll go as long as you want. If we go for 4 hours or 2 hours, I'll answer every single question. It'll be fun. So, anyways,
That's
let's go.
awesome.
Let's take a few minutes right now.
All right. So I have Anna that is asking. I am raising $980,000 to purchase two large multifamily properties in a large area in Tampa. How do I connect with people with self-directed accounts that want to invest and make their money work? That is a great question. That's what you did when you were younger. So how did you reach your audience?
I did that. I raised hundreds of millions of dollars, and I
Hmm.
didn't know I did that much until I looked back and I was like, "Oh my gosh, great question." And it's when I go around talking about people that are trying to raise money, some of the first things people talk about. Well, shouldn't they talk? They'll ask me about is how do I do it? How do I go raise the $980,000? So let me give you a couple tips. And this I get very passionate about this. In fact, when I do my session here in
Hmm.
April with you guys or May or both, I'll go deep into this if you'd like because I get excited about it. But a simple thing I'll start with is when I was raising a lot of money for my deals when I was literally in my late 20s, early 30s, I spent I failed in the beginning because I would talk about the real estate deal. I would, and I'll use your example. And I was excited about a $980,000 deal. I was going to make millions of dollars, or whatever the case was, right? Or whatever the case, the rate of return was going to be. And so I would lead with looking for investors to partner with me on this deal or to lend money with me on this deal. And what I found is almost everywhere I went, everyone felt like they were real estate professionals. I mean, just think about this right now. If you were to go ask your neighbor right now, uh, I've got I've got a real estate deal and I'm a real estate investor. Would you be interested? Most of your neighbors think they're real estate professionals already because they've bought and sold a home, which is so inaccurate. It doesn't make you a real estate professional if you bought and sold one, two, three, or four homes. But that was the problem I was running into is I was talking to individuals. So I'm getting to an answer here. Don't worry, I'm building up to it. But uh, most people lead with the wrong subject when raising dollars. What I found is I would find something that was unique and interesting and different in a group of with a group of investors to pique their interest. And again, I did not own a trust company like I do today. Back then, I didn't own one. I was a real estate investor, but I led with self-directing. I would go, and this is getting into your question now. I would go to these RIAs, these real estate meetups and get-togethers, and I would talk to people about self-directing, about what it was, how it worked. Did you know? Do you know that? Do you have an IRA? Do you have an old 401k? Yes, I got a real estate deal, by the way. How would you like to use or part of your retirement account? Did you know you can do that and partner with me and avoid or defer paying taxes altogether in this partnership or in lending to me on this real estate deal? So I found groups of real estate investors and I go to these different pockets in my city, different events, small, whatever. If there's 5 or 10 people or 50 or 100 people, I was out. That raising money is a full-time job. So there is no easy answer like, oh, just say this. Now, the last thing that I would say, and I'll go deeper into this again another time, is I didn't have social media. I'm old enough to say that there was no social media really back then. So I would absolutely go to social media in your communities and just talk about, like, for example, a simple thing saying, hey, anyone here, I mean, you can test a few different things out, but does anyone have an old 401k and they're not happy with the returns? Or does anyone just have an old 401k? That's it from a prior employer. Just ask the question in social media. If they say yes or message, then you can message them and say, hey, did you know you can move your old 401k and partner with me on your next deal or lend to me on your next deal if you have this relationship with them? Now, if you don't have a relationship with someone, you can't just go out and solicit to the world and say, invest with me, because there's certain regulations and rules you do need to have if you're starting to just solicit to anybody. But if you have a warm body, a community, friends and family and or, investors or partners, ask them about retirement accounts. Lead with that. Start talking about it in everyday conversations. I promise you, if you start talking about it almost every day or at least a couple times a week, within 60 days, you will find, if not millions, you'll find hundreds of thousands, and that can help you in your next deal. Sorry, I get excited about that question. So it's real, it works. I promise you, I did it a lot. So, anyways, let's move on to the next question.
Yeah, absolutely. So I have somebody asking, are we entitled to the tax benefits as individuals if the SDIRA owns the real estate asset?
No, great question.
That's a great
You
question. We get that
so
a lot.
so do you get the tax benefits if your IRA owns IRA owns a percentage of or all of an asset? You do not get the bonus depreciation tax write-offs. But I will say this: the perfect scenario is when there's an asset that you know you're going to have good tax benefits like bonus depreciation and write-offs. You should you should not use your IRA. Use your non-IRA funds for that, and then use your IRA funds for other things like lending and other opportunities like a flip where you're not going to get the tax benefits. Now, if you're listening to me and you're like, okay, Greg, that sounds awesome, but I don't have those kind of funds. I don't have like this pot of gold over here, a pot of gold over here. I can just pick and choose. You're not alone. I think there's
Mhm.
lots of people who only have one or the other. And so what I like to tell people is don't get too caught up in that. Don't say, oh, well, if you have an IRA and it's not performing well and you want to do better, invest it in real estate. You might not get the tax benefits, but you're going to get hopefully double-digit returns that are deferred and compounded. So that's still just
Mhm.
as powerful. So
Yeah,
good question.
yeah. I have Sherry that is asking, can you buy gold or silver in a self-directed IRA? I already have real estate investments.
Yes, you can
See.
buy gold and silver, you can buy Bitcoin, you can buy businesses, but yes, I would say there's been a lot of gold and silver, especially leading up to the presidential election and even after. A lot of gold and silver,
Even
and
after,
probably
yes.
probably today. I mean, after what's going on in the stock market today, there's probably a little more precious metals purchases happening. So yeah, you absolutely can. And again, email us or contact us.
Mhm.
We don't get compensated on any decisions or investments or golds or metals that you choose. But there are in our investment corner, there's a couple of companies that a lot of clients work with. So yeah.
Absolutely. Um, I have Jody asking, potentially a dumb question. No question is a dumb question, Jody. Does the interest compound if you took a loan out from your solo 401k? Would that be considered as an investment? That's a great question, actually. And the answer is no, it does not compound. So the interest that you're paying yourself back on that personal loan is going back into your retirement account. But it is a personal loan. So you're using it for anything that you deem necessary, but it's not compounding interest at that point. Um, Nicoletta is asking, what is your cost price to host serve our SDIRA 401ks. She's asking for costs to put it in like different. Please explain the cost structure for new clients. Thank you.
Do you want to explain it? Because I don't know which one she's talking about. Checkbook
I
LLC
th
or a traditional account?
I think she's asking for just a regular. So the fees depend on how much you're transferring over from your current custodian. So what we do is we look at a statement from your current custodian. We ask you, are you going to do a partial rollover? Are you going to do a full transfer? And then at that point, we'll go over. The fee is a one-time annual fee, and there are no transactional fees throughout the year. There's a lot of other custodians that are going to be charging you per asset. They charge you per quarter. They charge you per wire transfer. They charge you for all sorts of stuff. What we figured is we want to do a one-time fee that is just an easier, you know what you're going to get, you know what the fee is going to be for the year, and then that'll go ahead and go every year after that. So you would book a call with one of our IRA specialists. They'll go over the fee schedule with you, depending on what you have and what we're setting up for you. And then you can go from there, decide if you want to move forward. Um, Somebody's asking, what's the best strategy for investing in ETF funds on the stock market?
I don't have the strategies for ETFs, and so I don't want to give advice on that. Like I said, I'm not an advisor by any means, and I'm focused primarily on real estate. But we do have a lot of clients that do purchase ETFs. Their strategy, it seems like they follow different other people's strategies on how or what they're buying. So we do have a platform for that. It's Axos, and so you can, if you want to be in the market and if you want to buy ETFs, you can do that with us at Horizon Trust Company. So some clients who say, "Hey, look, I'm gonna roll my whole account over to you guys, and I'm gonna put part of it in a platform where I can still be in the stock market and purchase ETFs, and the other part of my funds I'll do all the real estate or precious metals, etc." So I don't have the strategy for you on that.
I have Farah that's asking, how fluid is an HSA account for investing? Can I use the checkbook to place money into the HSA to place in a brokerage account without restrictions? Can it only be drawn for healthcare qualified purchases? I can go ahead and answer this one. So the HSA account that we have, all of our accounts are self-directed accounts. So the same thing that you can do with an IRA, you can do with an HSA. So we would set you up with a checkbook LLC, which it seems like that's what you were trying to do. And then from there, you can do a brokerage account in the name of the LLC. Now, to answer your question for withdrawn for healthcare qualified purchases, yes, the IRS deems that the HSA is only for healthcare purchases. So when you do a distribution or if you're paying off any kind of healthcare, that'll still be the same restrictions for that. So the HSA, you still get the benefits of the self-directed part of it, but the IRS the IRS rules for the actual distribution are the same as well. Nicoletta's asking, for Roth for kids, we need to have the child on W-2 in order to put the money in the Roth, correct? If no W-2 available, how does it work?
You don't have to have them W-2, but they do have to be paid, even if it's 1099. So they just need to be paid. And so, the recommendation would be they have a bank account, right? And then they get 1099 income. So you pay them at least $6,000, and then they can contribute their $6,000 into a Roth account. So it doesn't have to be W-2.
Mm-hmm. I have Henry here that is asking, I have an old 401k from a previous, from my previous employer. Sorry, the chat went up, so I lost my place. I have a 401k from my previous employment that I would like to convert to an SDIRA and invest in syndicated real estate. My concern is the UBIT tax, which could be quite high. How can I minimize this tax?
Look, UBIT tax is a real thing, and it's kind of a bigger, longer conversation. And I don't want people to get too confused. And so, first, I'll say, in particular, a one-on-one call with someone on my team that knows this really well. We could talk about the particular asset. So I'd rather give you that help. Is schedule an appointment. Just say, hey, look, I've got a UBIT tax question, and I'd like to know more about the asset. One of the best ways of protecting yourself with UBIT or having less UBIT um, is the way it's structured as far as either equity or debt. And so if yours is more structured as debt, you're better off. But if there's equity, if you're in equity in a real estate deal, which I understand you might want, and then you're borrowing money, there could be some taxes that are due. And so what I like to do in this example to try to avoid or bring down some of those taxes is create my instead of being an equity investor on a deal, I like to create structures where I am a lender. And so I create the terms that I want as a lender, like they would be the similar terms if it were equity, if that makes sense. And so that's just one little thing. Like, for example, this deal, the forecasting is going to make me 20% or 25% per year on the equity side. I'll just say, hey, look, how about I get paid 18 or 20% deferred, maybe half now or all of it later, whatever the case is, but create a debt structure. And so that's one way of doing it. So, but again, let's schedule an appointment and go one-on-one on that and find out a little bit more about how it's structured, what your involvement is, how much owner and how many other investors, et cetera. And we can kind of dive deeper into that. Sorry, that's a harder one for me to do.
Yeah, and typically 401ks, which we offer solo 401ks if you're running a business, aren't subject to UBIT. So that would be something that you would talk to your IRA specialist and kind of go over if you qualify for that type of account. And that's one way that you can go ahead and minimize it. But again, schedule a call and we can go over that with you as well. Um, so I have, how do you transition an old 401k to an SDIRA? This one's an easy one.
Uh, the biggest one there, which might not, it's easy because we do it every single day. We probably do a dozen of them every single day, but really just schedule an appointment. All we need is if you got a copy of your old 401k statement, any one of them in the last 6 months, give us that copy. And then from there, we can help you get the application going. It takes about 15 minutes and a phone call to get you going, get your account set up over to um, get your account set up over with this Horizon Trust Company. So just a 15-minute phone call, have a statement ready so we can fill it out, but that would be it.
Mhm. Yeah, and we'll actually get on the phone with your resigning custodian. We have a liquidations team that can get on the phone with the resigning custodian and start that process for you. It can be a little intimidating, and it also can take a lot of time if you don't have this part of the process. So we offer
Mm.
that as part of what our process is, and that way we can go ahead and get the money invested for you as soon as possible. Once the money's here, then we have an investment specialist that actually goes over what you're trying to invest in, what the supporting documentation is, and what the next steps are so that we can actually move you through the process and get your first investment done as soon as possible. So it's a great question. Christine is asking, if I already have an SDIRA with you, how much would it cost to add a checkbook LLC? Is this part of the SDIRA or totally separate?
It is separate. I mean, it's different. And so a checkbook LLC is an entity that needs to be created, which we can help you do. And that entity is typically owned by your self-directed IRA. So you essentially have both. Most people, the first step is opening up a self-directed IRA. So now that's established with this Horizon Trust Company. You can invest in that, however, in different asset classes freely. But if you want to have a little more flexibility, you still have to make sure you do it correctly, and we can guide you through that. You'd set up a checkbook LLC. This checkbook LLC, the owner of it would be your self-directed IRA. That's how they work. And so that would then fund or invest into the LLC, and that LLC you now have control over. So you can invest in different things. You just can't, I mean, there's prohibited things. You can't take a
Mhm.
commission or a paycheck, et cetera. You got to make sure you keep that clean, and those assets in there, all the profits, et cetera, go back into your self-directed IRA. So yeah, that's how they work together.
Yeah. And one of the main key points of this is that it has to have a specialized operating agreement that actually has all of that Greg just went over in the operating agreement. Because if that's not on there, we won't accept it as a qualified entity. It has to have all of the specifications that it is owned by an IRA, who the manager is, that it can't be involved in prohibited transactions, all of that. And we'll actually go ahead and do that for you. We'll do the operating agreement and have you just sign it at the end. So it's a great question. Talk to one of our IRA specialists on how that works. And yeah, that is a separate, that's a separate product that we have for you as well. Uh, I Julie who is asking, solo K is or is not subject to UBIT taxes. I think she means UBIT taxes. It depends. So the solo pay for the most part is not. But that would be something that you would talk to a CPA as well, because that would be something that the CPA can go over with you. But yeah, that would be. Do you have anything to add,
Yeah,
Greg?
yeah. Look, we Claudia mentioned that often it's not there isn't UBIT with 401k, but because it's a subject, that's why we dance around a little bit. There is
Mhm.
some grayness in there and how you do it and what your CPA says, and so if you're sensing that, you're right. There is a little bit of dancing around it. We need to know more, and then we can give you our opinion, and then you can go back and talk to your CPA. So.
Yes. What is your opinion on leveraging cash value life insurance versus SDIRA for investments? This is something we get a lot. Cash versus Greg. I mean, not Cash. Carson. Carson is his son, and his
uh,
son is in life insurance. That's his area of expertise, though.
Look, the quick answer is I do both. I know my son does both. You know, leveraging your cash value policy and also a self-directed account it can work hand in hand. There are two different types of vehicles that do different things, and so there's different strategies where you can go and fund your, like, let's say you only have $6,000. Well, you would then go buy an insurance policy, cash value policy, borrow out against it after you put in the $6,000, take out the 5,000 or 5,500 that they'll let you take out, and then go fund a Roth, self-directed Roth. Now you've got a Roth in insurance policy. Now you need to make payments out of your pocket back to pay back that loan you just borrowed over time. But now you have this self-directed Roth account that you can go and invest and compound and do different deals. So you can do both. They are different. I do both. And this is something I will talk about when I do my one-on-ones with you guys. So, but uh, that's one example of how they can work together. But there's several others.
Yeah. Okay. Well, I think we have a couple of minutes. Do you want to go? We have one more question, and then we'll go into the promotions that I was talking
Yeah,
about.
yeah. Because we got to wrap up here shortly. Yeah, let's do it.
Yeah. Does the Checkbook LLC have to be open in the state that you live in? As you know, annual taxes in California are outrageous.
Hmm. No, it doesn't. Most of our checkbook LLCs are set up in the state of Wyoming, so
In the
that's
state of
that's where they're
Wyoming.
at, and I know that's one of the lower ones there are in the country. So, nope, they do not.
Yeah.
And we'll help you with that as well. Not a problem. So, good question.
Yeah.
All right, let's wrap here. Thanks for everyone here, and I think we've got. Now, are you going to share here this promotion for March?
Yes. So the promotion for March, we wanted to come up with something that would be exciting so that we can go ahead. Oh, March System by marketing team. It cracks me up, and it's so sports. So we have some promotions
By
going
the
on.
way, he created this in the last half an hour because we talked about
He
it
really
beforehand, and
did.
so
Yeah.
good work, Alex. Nice job. All right, so here's what we want to do, as well as whoever does this refers or opens the account. We're going to do what I said as well. So, but go ahead. You can review this, Claudia.
Yeah, so for new accounts, we're going to go ahead and give a discount of $500 off from the new account setup and annual fee. So, like I said, we would go over how much you're transferring over. So, from the new account and setup fee, we're going to go ahead and give a discount of $500 for the month of March. And for referrals, so usually we give out a $100 gift card for every referral that you send to us and that actually opens an account with us. Well, for the month of March, it's going to go up to $300. So that's a huge promotion. We are really excited about it. We love referrals. It's our a number one kind of client that we get, people that you talked about what your investment is and that they're ready to go ahead and talk to us about self-directing and how it works. So send us those referrals. Jody specifically, she was looking for how to talk. Now you got Greg's take on how to talk to people. Now you can send us those referrals. So if you have somebody on my team that you talked to already, Amber, Brandy, Brandon, then you can go ahead and send it directly to them, or you can go ahead and send it to me, and I will go ahead and get one of our IRA specialists on the phone. And then Greg offered his one-on-one consultation as well, or live kind of series, which is going to be really cool. I didn't know he was going to do that, but that's going to be, real estate education with Greg. So he's
There you
taking
go.
off his hat, his Horizon Trust hat, which he loves to do because his passion is real estate. So sometimes we have to tell him in compliance, okay, it's just self-directed. So I'm super excited that he's doing that. We will have some disclosures that say, hey, he's not giving investment advice. He's just telling you what he's done, and obviously he's where he's at because of it. So I'm super excited for that, and I'll be
Man,
in the back as well.
Alex, you created that so quickly. Now I don't know if I said day with Craig
You
Herlean,
did
but I
not
don't know if
say day.
I
We're
don't know
not
if
doing a
eight
day. No.
hours, but I did say I'll go as long as we need to. But anyways, thank you so much. Have a great week. Thanks for spending time with us. Reach out to us, email me with any questions you have. I really appreciate those that were listening in. So have a great day.
Have a great day. Thank you, guys.
Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.